sequence of returns risk, and safe withdrawal rates. Big ERN covers everything you need to know so that you don't run out of money in your retirement. Here we go. Welcome to Forget About Money, where we encourage you to take action today so that you can focus on what matters most to you. It's one thing to know if your money will last a few years in retirement, but it's another thing to know if it will last your lifetime. Today, I'm here with Karsten Jeske, aka Big ERN. He is the premier expert of safe withdrawal rates and sequence of returns risk. Welcome, Karsten.
Hi, thanks for having me on the show.
So, Karsten, tell me how you got involved in even thinking about that you were interested in sequence of return risk or safe withdrawal rates. I can't imagine you were 8 years old and that's what you wanted to do your entire life.
Right. So in 2016, right about 2016, when I started my blog, I got interested in early retirement, and I was probably FI or close to FI, and probably in hindsight, I was FI. In real time, I didn't quite trust my numbers yet. So I worked actually until 2018, until I retired. But as obviously the thought process was already going, and you save and you accumulate assets, and in some way, mentally that's the hard part, but mathematically it's actually the easy part to accumulate a lot of assets. Right? Just put money in, forget about it, and don't even check your statements, and then you end up with this big nest egg. But then withdrawing money. It was always on my mind, well, how much can you actually withdraw? And then Googling, is there any research out there that I can use to model my personal safe withdrawal strategy? And the only thing I found was basically the Bengen study and the Trinity study, which is so bland and so generic. And it has to be generic, right? Because these are studies that are published in academic journals, and you have to do something very generic, because if it looks like, well, this looks like your aunt's retirement plan with lots of bells and whistles, and she has a house here and a vacation home there. If it becomes too idiosyncratic, then nobody takes your academic or practitioner journal research very serious. So it had to be bland and generic. But again, I'm not bland and generic, right? I'm me, and I have all sorts of idiosyncratic parameters, right? I'm an early retiree. I may have some extra income first few years in my retirement, so something like deferred bonuses from my workplace. Then eventually I'm going to claim Social Security. That's the difference between a traditional and an early retiree. Traditional does it usually around the same time. And for me, there's something like 20-year or 20-plus year gap between early retirement and then claiming Social Security. And then once you get benefits, you can then draw down, you can then reduce your withdrawals from the portfolio. All of these bells and whistles are not modeled in these generic studies. So I thought I have to do this myself. And so in that process of studying, how can I model my personal safe withdrawal rate, did a lot of research. And again, I didn't find anything online that could help me. And I said, well, if I can't find it there, I have to do it myself. And this is how one thing led to another. Of course, I never thought that. I think in 2016, in December, was the first time I published series, the Safe Withdrawal Rate series, part 1. And I maybe would have had material for somewhere between 5 to 8 blog posts. And I thought, I'm just going to write this series, and then it's good and it's done. But then, of course, you can't write fast enough to cover all the topics that come up by the time you start digging, and you do this rabbit hole thing, right? You go and then you find more stuff to write about. You find stuff that readers point out, right? So it's not a one-way street where I write and I'm pontificating here and preaching and people just consume. There's a two-way street, and I get a lot of insights and impulses from my readers. And so this is how this has grown now to 60 plus parts in that series. So
now, I can't imagine somebody not knowing who you are by now, at least someone who might be interested in early retirement or retirement and wondering if their money is going to last. But for someone who may have never heard of you, you're not someone who just picked this up as a hobby. Like for me, I'm a hobbyist. This is not my career. I'm a numbers guy, but I never got paid for doing financial analysis or anything like that. You, on the other hand, this is not you didn't come out of nowhere and just start doing this research. You do have an economics background. Can you explain why someone should be listening to you and reading your blog?
Right. So, I mean, it's not like I did this for a living, right? I wasn't paid ever in my career to study sequence of return risk, but I have something that's correlated with that, right? So I studied economics. I have a PhD in economics. So I know a lot about quantitative methods, both in economics and in finance, because I used to work for the Federal Reserve for a while. I was teaching in academia for a while. In economics mostly, so mostly macroeconomics. And then in finance, I worked for Bank of New York Mellon Asset Management. It's one of the largest asset managers in the world. And we were not doing stock picking. This is what people usually think that we would do. Some people probably there do that, but I was in the global asset allocation research. So we were thinking about index investing, but well, what are the weights on all the different indices, right? US stocks versus non-US stocks, bonds versus long-term bonds versus short-term money market style funds. And then also some commodity trading. So we would do that and try to eke out a little bit of extra return, which, by the way, is really hard. We might get into some of this later when we talk about some tactical asset allocation or bucket strategies or something like that. But anyway, so I've been doing related research my entire life, but I have to admit that this whole retirement withdrawal stuff is actually new, because if you're working in finance, right, you are thinking in terms of, well, I maximize my risk-adjusted return. Right. Risk-adjusted return means you look at something like a Sharpe ratio and how much excess return do I get per unit of risk that I'm taking on. And you are, for the most part, thinking like a buy and hold investor. And so the amazing insight that I got from my research on safe withdrawal rates is that if you have this fixed amount of assets and you're withdrawing from that, and there's not much more money coming in. So for example, like in a pension fund, there's usually money coming in, money going out, unless you're some very, very mature pension fund that has only 70-year-old retirees and you're basically drawing this down. I mean, the modern pension fund, there's money coming in, money going out. You don't really face this issue of sequence of returns. And I have to admit that maybe it was my ignorance, but in my entire career in finance, I have never encountered this issue of sequence of return risk. And but you do have a similar and a related risk, right? I mean, you obviously have this almost reputational risk, right? So if you are an asset manager, you want to avoid a strong drawdown because, well, the client is going to fire you and then hire somebody else back, and then they ride the market up again when the next bull market rolls around. So you also have a similar problem, but you call it differently, right? You call it, well, we want to avoid this negative skewness in returns. We don't want to have these really big drawdowns, and but it's for a different reason. It's not sequence of return risk. It's more of a reputational risk. And so amazingly, this whole issue of sequence of return risk in retirement was something that I learned afterwards and read about it and then did my research on that. So and again, so which is good, right? Because what I did on my blog is not exactly what I did, but it's a corollary of what I did in my various jobs before.
So you clearly were busy as a professional,
right?
And if anybody were to go to your blog, earlyretirementnow.com, they would see that this is not just surface level research.
Right.
How did you transition from all that work for pay officially to then starting your blog and having a passion for helping others? Is it your passion for wanting to help others what started the blog, or maybe that's what's keeping it going?
Right.
Or was it just your desire to solve this problem?
Yeah, it's a little bit of all of the above. So I as I said, I am just a naturally curious guy, right? So if you work in academia, sometimes you don't take anything for granted, right? So if somebody publishes something, you want to get in the weeds and try to understand every single line in some mathematical proof, every single result in somebody's paper and the intuition behind it. So I actually started the blog when I was still working, which was a little bit of juggling a lot of things, right? Family with a wife and a small kid at home, a busy career and a blog. And I tried to publish something. Actually, I published more when I had a job than I'm publishing now. But admittedly, the blog posts early on, they were probably not quite as deep as I can go right now. So sometimes I write something like 4,000, 5,000 word posts with a lot of custom simulations. So I don't usually write something, I read something here, and then I paraphrase what I read and then publish that as a blog post. What I'm trying to do is I try to publish something that you can probably not read anywhere else. or if you read it anywhere else, I was able to redo all of the work and check it. And so I mean, this is basically out of academic curiosity, right? You want to do everything yourself and go really deep and try to understand what works, what doesn't work. And this was something, for example, in my job as when I worked in finance, right? And you come up with some kind of an idea, or here's a signal for, I'm going to shift into this asset class if this signal shows a green signal. And then you simulate that, and then suddenly you realize, well, it doesn't work. And well, what do you do with that? Do you just throw up your hands and say, well, it doesn't work, sorry, try something else? No, you try to go in and try to find out why it doesn't, right? And this is also something with the safe withdrawal rates, right? So sometimes people tell you, the withdrawal strategy is really easy. Can't we just do X, Y, and Z, right? And sometimes you can just write right off the bat. You can say, well, this is kind of nonsense. But sometimes people have brought forward some sometimes intuitive solutions to sequence of return risk, and but then they don't work, or they don't work even 10% as well as they are marketed. And the only way you can really confirm that is if you look under the hood and see how does this work. I mean, sometimes people tell me, well, can't you just build a portfolio with a high dividend yield, right? And then you never dig into the principal, you just live off the dividends. And then because you never dig into the principal, you are avoiding the sequence of return problem. Sounds really good on the surface, but then if you look at, well, what happened during past recessions, right? So some of the high dividend stocks, some of the high dividend bond indices, they also became really risky, right? So you say you go from treasuries into corporate bonds, and then you go from investment grade corporate bonds into high yield bonds, or from high yield bonds into preferred shares, and you go riskier and riskier. Well, guess what? They also got hammered, say in the global financial crisis. So a lot of interesting solutions, they only look interesting on paper, and you can't really use that. And yeah, I mean, you have to really get your hands dirty, and you can't just wave your hands and think you found a solution to sequence risk if you don't do the simulations. And I mean, I've tried to, and obviously it's not like I try to be the Grinch here, and not trying to talk people out of retirement, but in fact, I want us to find a solution to sequence risk, right? I mean, it would be great. I would probably get maybe not the economics Nobel Prize or anything, but I would probably become very famous if I found the definitive solution to sequence risk. So I'm very much in favor of finding a solution, but sometimes it also means that I'm the one who has to shoot down all of the crazy ideas that people bring forward there. So
I've been in the audience of a presentation where you did just that. And it wasn't as bad as you're saying it. And it was very enlightening. And you brought up a lot of things for not only early retirees to consider, but just retirees in general, or anybody actually just accumulating their wealth.
Right.
So let's take a huge step back, Karsten. We already got into the weeds a little bit. If someone has never heard of sequence of return risk, let's define that.
Right.
And let's define safe withdrawal rate, the relationship between the two,
right,
and why a retiree should consider this in their planning?
Right. So one doesn't go without the other. So let's start with the most basic one. What is a safe withdrawal rate, right? So safe withdrawal rate is, so you imagine you have a portfolio and you ask yourself, how much can you withdraw in the first month, the first year, and keep that spending level the same, at least inflation adjusted, over the retirement horizon, usually 30 years or so. And normally what you would have is something, it's not 100% equity portfolio, something more balanced, something like a 60-40, 60% stocks, 40% bonds, maybe go all the way up to 80-20. So somewhere between 60 and 80% stocks and the rest intermediate bonds, maybe 10-year treasuries. So the question is, how much can you withdraw without running out of money? And so research has shown that even during the very worst market events like the Great Depression, the dot-com crisis, the global financial crisis, the 70s were also very nasty. So the oil shocks in the 70s, and then the Volcker shock with higher interest rates in the early 80s, so that sank the stock market and the bond market. So we have a lot of market events that we can expose this to. And it turns out that right around 4% seems to be the floor. This is how much you can withdraw without running out of money. And yeah, maybe there were some, if you have been so unlucky that you retired right at the peak, right before that big market meltdown, I think in September 1929, you would actually dip a little bit below 4% of a safe withdrawal rate. You could have still withdrawn something like 3.8%. And I think 3.8% is roughly what you could have withdrawn over 30 years, both in 1929 and then also right before the oil shocks, mid-60s or 1972. There are some retirements, so historical retirement cohorts where you also dipped a little bit below 4%, but not much. So it's quite amazing that even in these absolute worst case scenarios, you could have withdrawn 3.8% is not bad. And so the question is, so the rhetorical question is, what causes these low safe withdrawal rates? And somebody might be tempted to say, oh, the average return over your 30-year retirement was really low during some of these events. And what people will be amazed to hear that, for example, going from 1968 to 1998, that 30-year return window, I once calculated, so a balanced portfolio, something like 75 stocks, 25% bonds, would have had an average return of 6.1%. Make it 6%. 6% in real terms. So why is it that your safe withdrawal rate was only 3.8%? If the average return point to point, buy and hold, was 6.1%. Well, it's the buy and hold average return is meaningless if you're taking money out, right? So if there is a recession that's deep enough that takes your portfolio down, and then you withdraw from the portfolio, and you withdraw while your portfolio is down. So think of that as the opposite of dollar cost averaging, right? So you, instead of buying more shares on the accumulation phase, instead of buying more shares when prices are down, no, you are now selling more shares when the portfolio is down. So even though the point-to-point return 1968 to 1998 was really impressive, the first 15 years, I think it's 14 years, it's 68 till 82. I think 82 was the absolute low point in real terms, both nominal and real terms. The performance was so poor over the first 14 years that you would have depleted the portfolio so badly that even with the subsequent amazing returns that I think were double digit over the second half of your retirement, because you depleted your portfolio so much, if you kept withdrawing 4% of that initial amount, that would have amounted to something like a 20% effective withdrawal rate. What you withdraw as a percent of your portfolio, so that even that very impressive return recovery would not have saved your portfolio. So it means that the average return over your retirement horizon I wouldn't say that is meaningless for your retirement success, but there's only a relatively useless small correlation between the overall average return and the returns that matter most are, say, the first 5, 10, maybe 15 years of your retirement horizon. And then the subsequent T minus 15 years is, and again, it's not meaningless. It's good that your portfolio recovers again. But if it's been wiped out so badly over the first 10 years, there's really no saving your portfolio. So that means it's actually the distribution of returns, whether it's good returns first and then bad returns later versus the other way around, matters a lot in your retirement outcomes. And it actually matters more than the average return. So it's actually all of the historical failures of the 4% rule happened when the average return was at 4 to 6%. And it's just because of this crazy volatility, you had very poor returns in the 15 years and then extremely good returns in the subsequent 15 years. That's what wipes out your portfolio. And there were tons of examples where returns were much lower than 4%, and you still survived with the 4% rule. And then, of course, if you have returns, 8 or 9% in real terms, then you don't have to worry about the 4% rule. Then you're so far beyond, at least in historical simulation, then you're so far beyond running out of money that you don't have to worry about. But there's this sweet spot in the middle. If you have average market returns and the distribution of good versus bad is going against you, then you can actually run out of money. And that usually happens at these historical market peaks right before the global, the Great Depression and the 1970s.
So let me see if I can sum that up. Two retirees with identical average rates of returns and exactly the same portfolio balance at the time that they retire, but they experience different return sequences, can experience vastly different outcomes. For example, retiree A faces a bear market early in retirement. Their portfolio will deplete faster. And retiree B faces a bull market and their portfolio grows, which provides more cushion for their later years. Does that sum up?
Yes, absolutely. And the span could be really wide. So I did some simulations where, you look at all the retirement cohorts that had a 5% average real return, not nominal, but real return. 5% and you withdraw 4% at the beginning, you shouldn't run out of money. Well, guess what? There are some cohorts that ran out of money with a 5% return. And then there's some cohorts that ended up with, I think it's more than $2.5 million. So more than 2.5x after withdrawing. They still have 2.5x what they started with. So it's a $3 million wide interval after 30 years, and this only blows up more if you go with a longer retirement horizon. And this is a 30-year retirement horizon for traditional retirees. For us early retirees, this is more extreme. So so that's exactly what sequence of return means.
So let's say we're getting close to our magic number, our phi number, our 25x, or whatever that is we've decided for our own portfolio, our own lifestyle, whatever that is. As we get closer to that, pulling the trigger and getting out of the workforce, officially retiring, or moving on to something that we're passionate and that we love and that we enjoy. But that's before that official retirement decision. What should we be looking at, like market factors, to try to not trying to time the market necessarily, but are there some indicators that say, hey, now might be a good time, now might not be a good time to actually retire?
So, and again, you may still retire. I think you should be able to retire in any market environment. So I don't think there's any market environment where you would say, I can't retire, period. Right? So I think the dial that you should work with is not whether or not you retire. The dial should be, well, how much are you going to withdraw? Because I'm amazed that you could have done a 60-year retirement and you would have retired right before the Great Depression. And I think even a 3.25% withdrawal rate would have survived for 60 years. So it's not that you have to set your withdrawal rate to zero, which means not retiring. It just means that you might have to retire with a little bit smaller budget. And so that's one thing to consider. So I never want to talk people out of retiring. I'll just tell people, well, don't retire with too generous of a budget. The other thing is that I think that I have been well served with a essentially 100% equity portfolio during accumulation. And I don't know whether this was just dumb luck or skill. It worked out really well for me to take a very aggressive approach to the accumulation phase. But in retirement, you have to be a little bit more cautious. And there might be, if you're a very high-powered fire influencer and you make enough money from your blog and podcast that you don't even have to withdraw money, yeah, then you can keep that 100% equity portfolio. But if you actually take money out of your portfolio to live in retirement, you should not be 100% equities, right? So you should have some diversification benefit, and you should have somewhere between 20 and 40% diversifying assets, and that would be likely bonds. Now, there might be some people that are very heavy into real estate, and you have a lot of very good cash flowing real estate assets. We might talk about that, but the average retiree who wants to be really hands off, do this completely the financial asset way, you cannot get away from diversifying your portfolio a little bit, because even though 100% equity portfolio obviously has the best average return in terms of return volatility and then also sequence of return risk, that would be a terrible idea. And in the worst possible cases, you would drag your safe withdrawal rate actually below 3%. There would have been some historical cohorts where 100% equity portfolio would have sustained only something like a 2.75% safe withdrawal rate. So don't be too aggressive. I think it would be good that before retirement you shift into a little bit more diversifying assets. And the nice thing is, and this is the beauty of what has changed over the last few years, is that bond yields are actually now more attractive, right? I wouldn't retire on a 100% bond portfolio, but as a diversifying asset, mixing it in a little bit with an index equity portfolio, I think it works better now. And use that opportunity because I think the next recession is again going to be something like a demand shock recession, where inflation is going to go down and the Fed will lower interest rates. And it's going to be good for bonds. So your stock portfolio is going to fall, but your bond portfolio is going to diversify that, and it will actually go up. So now is actually a good time to be a little bit in fixed income.
So you talked about some strategies already that not only retirees, but pre-retirees use to mitigate sequence of returns risk. But you also alluded that during your accumulation phase, you were very aggressive and almost 100% stock, if not 100% equities. Stock, equity, right. Same thing. Do you advocate like a complete mindset shift the minute you retire? Because you just, during the accumulation phase, you're advocating for be very aggressive, 100% stocks or equities. And in your retirement mindset, you said, let's diversify, and
right,
and it's going to be better for you to weather the storms.
Right. And it doesn't have to be a drop of a hat switch in terms of philosophy. It could be some gradual process for maybe the last 2 to 5 years during your accumulation phase. You already shift a little bit into bonds. If you are very dead set on retiring at a particular date, right? Because some people are military and they get to that 20-year deadline and they say, I want to retire then, and not a day later or not a week later, then maybe you smooth out that, because it's possible that exactly at that date we're gonna be in another bear market. Right, so it could have been beneficial for you to already shift out a little bit before that. It also matters, right? Tax consequences, right? You don't want to do that shift in a taxable account and sell 30% of your equity assets in a taxable account and move them into bonds and have these huge capital gains. So it takes a little bit of pre-planning, right? How do you shift into a safer portfolio without realizing a lot of capital gains, all in a taxable account? So it takes a little bit of planning, so don't delay that planning until the very last minute. But I've run some simulations and looked at, so if you are a little bit flexible and you say, well, if I'm going to keep 100% equities until I retire, and if it doesn't work out and it takes me a year longer, I'm fine with that. So you roll. I mean, for example, most bear markets are like the bear market we had in 2022, right? So it's down, but it didn't last forever, and it recovered relatively quickly. Not as quick as the 2021, but so the 2022 was a little bit more like a garden variety bear market, and you just retire a year after, and you have the flexibility to do that. Maybe then you can keep 100% equities until the day you retire, and then you do some shifts in the portfolio. But even then, maybe I would be a little bit hesitant to do these big shifts all in one day, because you just kick yourself afterwards and say, I could have waited a week longer, and the equities would have rallied a week longer, and the bond market would have been better prices too. So maybe do that also. You do a few percent every month, and you do a little bit of a transition to have this regret risk, and so you're not overreacting to something, and then automate that too, so you take the emotions out. But so it definitely that mind shift from accumulation, taking a lot of risk, to decumulation, where you have to be more cautious. That is probably something you want to plan for, and you want to do a shift. I mean, there are people who basically propose target date funds where you shift out of equities over a 20-year horizon. Now, I think that is probably not recommended for early retirees, because 20 years might be less than your accumulation phase. So you want to have, at least for most of your accumulation phase, you want to be at that, I would say, 100% equities. I think target date funds, they are kept at 90%. There are some ERISA rules that basically keep this fig leaf of, we have 10% bonds. We need some diversification. So if somebody complains and sues us, we can show, we had a little bit of diversification. So target date funds, probably not a good idea for early retirees. You have to custom fit that more to your personal preferences, and then also, I think a lot of target date funds. I did some research on how target date funds were constructed. Mm-hmm. They are usually calibrated to through some Monte Carlo simulations. In Monte Carlo simulations, there's a little bit of a difference between Monte Carlo and actual market data. It's actually the market often recovers a lot faster than a Monte Carlo simulations, and that's why target date funds, they have to roll out already 20 years before retirement, whereas with actual market data, I think you can take a little bit more risk, because sometimes market overreacts, like in 1987, the flash crash there, or 2020, right? That recovered so quickly. The bear market only lasted for a little over a month, and then within 90 days or so, it was a new all-time highs again. I think it was a little bit more than 60 days, but I think by August of 2020, we had new all-time highs again. So, which is something that you can very well calibrate and simulate with a Monte Carlo. So I usually stay away from target date funds. I think especially in the FIRE community, because our accumulation process is a little bit compressed, you can probably do better by managing this yourself, 100% equities. And then towards the end, you roll a little bit out and maybe get to something like a 75-25 or maybe even 60-40, because bonds are looking really attractive now again. So And then in retirement, you might actually roll back into equities a little bit again, which is another reason why I don't like target date funds so much, because target date funds, even in retirement, they keep rolling out of equities, which is the opposite of what you want to do, because the one effective way to hedge a little bit against sequence of return risk is to shift very slowly back into equities. So that hedges a little bit of the sequence of return risk, and we can talk about that more in detail later. But that was one method that I found, and I'm not the inventor of that. There's other people have written about that too, Michael Kitces and Wade Pfau, I think. So it's called the reverse glide path in retirement, so again, at retirement, that's basically the very risky time where, well, what if I just got lucky and I rode the wave up and I'm retiring right at the peak of the stock market and then everything falls apart again. So that's the time when you want to be a little bit more cautious. And even though I've been aggressive, even I have taken my foot off the gas pedal a little bit at my retirement date.
And by foot off the gas pedal, you mean you've put you've allocated a higher percentage of your portfolio to bonds than equities.
To safe assets, bonds. Yeah, that's right.
Now, please correct me if I'm wrong. You are a pro and an expert at this, and I am not. The Trinity study, I believe, at least one of their sub-studies was the 4% rule was based on a 60-40 portfolio. Is that correct?
I think they did in 25% steps. So 0, 100, 25, 75, 50, 50, 75, 25, and 100, 0. So this is what the tables look like. And then they said that right around the 50-50 and 75-25 is where you have, you basically minimize the risk of failure. The 100-0 gives you better average returns, but also gives you slightly higher failure risks. And so that's what I remember from the Trinity study. But there might be some newer versions of that where they revised some of that. But yeah, so that's what I remember. Is you look at the 4% withdrawal, and then you look through the table through the different asset allocations. And right, the sweet spot is somewhere between 50-50 and 75-25.
And your personal portfolio right now is 75-25?
Yes. So, yeah, right around 75-25. And it's not literally in these assets. I have some other assets. I have a portfolio where I have some preferred shares. So preferred shares, a hybrid between stocks and bonds. It's not quite as risky as stocks, but it's still a lot riskier than treasury bonds. But they definitely have some interest sensitivity to them. So if interest rates were to go down and crash overnight, because the Fed takes interest rates down, so then that would be good for the preferred shares. So I have a portfolio that acts a little bit like a 75-25 portfolio, even though it's not quite a 75-25 portfolio.
So on your blog, Early Retirement Now, I just saw that you posted number 61 in your Safe Withdrawal Rate series. So for somebody who doesn't want to read or write 61 blog articles, are there rules of thumb that us lay people can use and refer to help manage our portfolio through these sequence of returns risk?
Right. So very important. So don't read this part 1 through 61 because it becomes jumpy. And this is the order in which I wrote it. But there is a landing page. So if you go to my blog and at the top menu, there's the SWR series, or you type earlyretirementnow.com/SWR. I think it's case sensitive, small letters, SWR. You should get to a landing page, right? And the landing page is one blog post where I write about my general philosophy, what I'm doing, what are the different, and it has a little blurb on all of the different subtopics, right? It writes something about sequence of return risk. It writes something about, well, could you hedge against sequence of return risk with certain basically asset allocation strategies where you strategically or tactically change your asset allocation over time. What are some subtopics. How do you mix in real estate or some other alternative assets like gold and commodities? So for each little subtopic, there's a little blurb and a paragraph, and with a link to that specific blog post. And if you're not interested in that, you can skip that. But if you read that landing page, you might get some additional information. And then also occasionally I write something a little bit tongue in cheek, right? So the last one is called 10 Things the Makers of Fire Don't Want You to Know, which was actually the presentation that I gave at the San Diego Campfire. And of course it has changed a little bit over the months. But this is basically the blog post version of that talk. So 10 things that people think they know about fire and safe withdrawal rates, where I beg to differ and maybe demystify and do a little bit of mythbuster work on some of these generally accepted wisdoms in the fire community. And I did a previous one. I think that is part 26. Yeah, that is 10 things the makers of the 4% rule don't want you to know. So there's a similar post with, again, tongue in cheek. The way I got this was there was an old money magazine. I think it's called Smart Assets or Smart Money. It was a paper magazine, and they had usually a one-page article on 10 things your real estate broker doesn't want you to know. And then it kind of told you a little bit about the dirty secrets of one industry, is a real estate or insurance business. And so I was inspired by that guy. And again, it's a tongue in cheek. Of course, I'm not saying that there's some grand conspiracy theory that the fire bloggers don't want you to know this. They probably don't know it themselves either. So so sometimes I have these more overarching posts where you could also start with that, right? So that might be something that you read after the landing page, and then maybe get some more ideas. So because maybe not everybody wants to read everything. And that, by the way, there's some readers of my blog that have been around since I started my blog, and they tell me, I read everything, and I read it in the order it came out. But of course, if somebody just finds my blog, and shame to you if it took you so long to find my blog. No, I'm just kidding. So if you just find my blog, it could seem intimidating to see 61 blog posts, and would take a long time to dig through that. But so, obviously go to the landing page, and then different people with different preferences can read different posts. But I always say, look, it took you so long to accumulate assets, right? And now you're retiring 20 years early. So you're giving up 20 years of earnings, right? When is the last time you purchased something 20 times annual earnings, right? For a car, you buy a new car, and it's maybe a quarter to a half annual earnings, and you do a lot of research, right? You buy magazines, you compare, you go to different dealers, and you do some haggling here, haggling. Maybe some people do this more impulsively. Or with a house, right? You buy a house that's maybe 3x to 5x, in some places maybe 8x annual earnings. And you imagine how much research you do for that. And now you're doing 20x annual earnings, and you say, well, I don't want to read 60 blog posts. It's going to take me 60 hours, or maybe 30 hours if you can read maybe one blog post in 30 minutes. You don't want to spend 30 hours to read through my series. I just have to wonder why. I can understand that it's a lot of time commitment to do this research, but it obviously took me a lot of time to write all of that, right? So you can read it in an hour or in half an hour. It took me 20 hours to put that together. You're obviously doing something that is quite consequential and quite substantial from a opportunity cost point of view. Maybe you want to do some research before you do that. And so that's some of the feedback I get, right? They say, well, yeah, I was ready to retire. I would have never pulled the plug if your series has given me the confidence to do this. And I also have, so for example, I have an Excel sheet that I publish, a Google Excel sheet where you can run your own simulations with your own supplemental cash flows and your own parameters, the length of the horizon, and then see what would have been the worst case scenarios historically. And a lot of people tell me, because I did this, I could convince my wife, hey, my portfolio passed the EARN test, and so she gave the green light to retire now. And or vice versa, right? Sometimes the wife does the financial planning, and then the husband was skeptical, and then the husband came on board after he read and he looked into the simulation and says, this is. And by the way, sometimes people also find that their personal withdrawal rate is more than 4%. Right? So not everybody retires the way some of these famous influencers, right? Somebody retired at age 22 or 28. No, most actual people retire in their 40s or 50s, and they have supplemental flows like company pensions, military pensions around the corner. Once you factor that in, you would be crazy to withdraw less than 4% today, because you withdraw a little bit more than 4%. You might draw down your assets over the first 15 years, but then you get your Social Security, your military pension. Once you factor that in, you might actually raise your safe withdrawal rate to much more than 4%. So some people retired, and if they had believed the 4% rule, they would still be working. But they did the research with my tools, and were actually able to retire earlier. So my personal estimate is that it's probably something like an 80-20. 80% of my quote-unquote customers, they retire earlier than with the 4% rule. But there were some people where I had to say, well, probably you want to be a little bit more cautious because they're very young and Social Security and pensions are very long away. Probably be a little bit more cautious, but it pays to do your research, especially considering you have been doing this. You have been frugal for the last 10 to 15 years, and you accumulate assets. And don't you want to do the analysis a little bit more carefully, and not just retire willy-nilly and use some off-the-shelf 4% rule? I would prefer to do a little bit more custom tailored.
So if someone has gone through and thoroughly explored their particular sequence of return risk, or at least the idea of sequence of return risk in their current portfolio, and used your tools to determine their safe withdrawal rate, and they're still around that 3.8, 4.2 range, where they might be that little more cautious scenario, but they still want to retire, and then they do retire, what are some strategies that they can use to help manage sequence returns risk? I know bucketing strategy is one of those that people tend to come across. Can you explain what bucket strategy is, how someone would use it, and whether or not you advocate that strategy?
Yeah, I don't recommend a bucketing strategy. And I've had 2 blog posts. I think it's number 48 in the series and 55. And the problem with the bucket strategy is it really sounds like what Rick Ferry described in his podcast appearance a few weeks ago on your podcast. It sounds a little bit complex and fancy, and it might actually be almost like a behavioral crutch that some people use, and then also some financial advisors use, because they say, look, you have this cash bucket and you take money just out of the cash bucket. What you don't realize is that, the money that refills the cash bucket comes out of the bonds, and what is missing in the bond bucket comes out of the stock bucket. So effectively, your assets are coming out of your stock and bond portfolio, which is exactly how I simulate my portfolio withdrawal simulation tool. So I'm not saying that a bucket strategy is going to be anything evil and is not going to blow up your retirement. I'm just saying that a bucket strategy is not going to enhance your retirement. Even though I think some financial planners are using this as a kind of a hook. Well, we're going to manage this for you, and to make it complex enough that you didn't feel like you could do it alone. And I think this is a little bit of false advertising, that a bucket strategy could actually increase your portfolio success in retirement. And so I've run some simulations, and I can show you examples where a bucket strategy would have done a little bit better. And I can show you examples where the bucket strategy actually did a little bit worse. Nothing catastrophically worse, right? Nothing catastrophically worse where with the 4% rule, with the fixed asset allocation, you would have done just splendid. And then with the bucket strategy, you would have blown it up. Another thing that people don't quite understand with the bucket strategy is usually what you do is you let the bucket weights go a little bit away from your target weights every once in a while, and then you rebalance it again back to target. And you're not really sweating, if you have something like a 70% stock, 25% bond, 5% cash bucket. Yeah, if the cash bucket is down to maybe 2%, now you have to replenish it again. Oh, and if the bond bucket goes from 25 to 23, now I have to put money back from the stock bucket into the bond bucket. So the percenting, the differences are really too small to make a huge difference. So what I'm trying to get to here is that if you consider my approach, right? So imagine somebody plugs into my spreadsheet 75% stocks, 70% stocks, 25% bonds, 5% cash. And you keep it at that same level for your entire retirement, right? So you rebalance monthly even. Doesn't really matter too much if you do monthly or 3 months or 6 months rebalancing. Wouldn't make a huge difference. But so it's actually easier to simulate if you were to rebalance monthly. It's harder in practice, but it's easier to simulate, and it doesn't make too much of a difference. And now somebody runs this bucket strategy where, yes, now your equities are down. So instead of selling equities when they're down, I'm still withdrawing only from my cash bucket and from my bond bucket. Well, but eventually you have to rebalance, right? There's no way around. In fact, at the very least, you have to rebalance when you run out of cash and bonds, right? If nothing is left in those buckets, then you have to take it out of stocks. And so the question is, when do you put money back into these other buckets? And it's not really that obvious that you would do better by now tactically timing. You're now changing your weights. And this is, for example, you talked to Rick Ferry about what do you think your chances are as a retail investor to tactically time stocks versus bonds versus cash? You are not going to be successful at timing the equity risk premium. And I can tell you this from experience because I was in global tactical asset allocation. There's a very, very complicated process. And as actually with only 3 assets, stocks, bonds, cash, it's very complicated. You can maybe get a little bit of traction if you also have some tactical allocation between different stock markets, right? US stocks versus Canadian stocks versus German stocks and French stocks. You might get a little bit of traction there, but just timing the stocks versus bonds versus cash is a very complicated process because everybody is trying to do that already. Pension funds, hedge funds. So you as a personal retail investor, you are not going to generate any excess return from timing stocks versus bonds versus cash. So sometimes it can go in your favor, sometimes it can go against you. And even if you had a little bit of skill, so imagine you could generate a strategy where you added maybe 1% extra return with this stock versus bond versus cash. And that, by the way, that would be totally utopian. You're not going to get that. But let's very generously, I tell you that you could do that. You're not going to do that with your entire portfolio, right? I mean, you are not going to be, you, Dave, today you're 100% equities, and then tomorrow you shift it to 100% bonds. And then, okay, no, bonds is no longer good. You take a 100% bond portfolio, you put it in 100% cash. And you jump 100, 100, 100, 100, 0, 0, 0, 100, 0. You're not going to do that, right? You're going to do that maybe with a 3 to 5% share of your portfolio, right? Where you do, well, I'm going to bump into these guardrails around my weights. And I might have this maybe 3% or 5% guardrail system where sometimes I withdraw from cash, sometimes I withdraw from bonds or stocks. And you have devised some kind of a system where you can generate a 1% alpha doing that. But the 1% alpha is only applying to 3% of your portfolio, because that's the one where you very, very actively and tactically time. So that's just going to add 0.03% to your return. So if you can add maybe 0.03% to your safe withdrawal rate, so instead of 3.5, it's 3.53%. Maybe a little bit more. It depends on how the safe withdrawal mechanics work there. If you're depleting assets or you're maintaining assets. But you're not going to take a 3.5% safe withdrawal rate and make it a 4% withdrawal rate, but just doing a little bit of timing around your 3% guardrails. And so this is really the a little bit of false advertising that and by the way, the person who is very much in favor of this bucket strategy is Fritz, right? So Fritz from Retirement Manifesto. We're good buddies, and so we really like each other, and we started blogging around the same time. And you should have him on the show. I think he's a good guy. But I asked him, okay, so do you generate any alpha with your bucket strategy? And of course, he has to admit he cannot generate alpha with his bucket strategy. And then I said, okay, well, case closed, right? So if you cannot generate alpha, if you cannot show me how you outperform a fixed, static, strategic asset allocation, then we're done. I mean, but I think it might be a good strategy for people trying to tinker a little bit with the portfolio, and it might get them from a behavioral, almost psychological sense to get them over the edge to actually start withdrawing money. Oh, I'm just taking it out of the cash bucket. Oh, by the way, I'm still selling stocks. I put it back into the cash bucket. And maybe if that helps you, that's fine. But I have more of the philosophy that I never tell my readers, well, you know what, you're kind of too dumb to know what's going on. And I try to give you a different story, some mental hacks to overcome this. I would like to give you the unvarnished truth on what works and what doesn't work. And in my view, bucket strategies don't work. Now, what does work for hedging at least a little bit against sequence of return risk would be not really a tactical shift from stock versus cash versus bonds. It would be what I call a strategic shift over time, right? So you start with a little bit less aggressive and more conservative allocation at retirement, because that is ground zero. That is the most dangerous time of your entire financial career, by the way. And then you shift back a little bit into stocks. And what that does is, and it's what you call a hedge, right? And a hedge against sequence risk is sometimes you do better and sometimes you do worse than a static allocation. But the times when you do worse would be, well, you retire and the market rallies for 5 more years, right? Well, if you now started with too much bonds, yeah, you're missing out a little bit on the upside. Well, but that would have been a retirement where you didn't have to worry about running out of money anyways, right? So you give up a little bit on the upside, but it would work really well if you retired at the peak of the market, and it would have been a little bit better at each of the past worst case scenarios. So 1929, 1964, 65, 68, 1972. And it would have helped you there, but again, not tremendously, right? I mean, we're talking about maybe you can take up your safe withdrawal rate. If your safe withdrawal rate would have been 3.3% otherwise with a fixed allocation, with a glide path, it would have been 3.5%. That's still good, right? It's not quite 10%, but I think it's something like 7% increase, 7% increase in your budget right? 0.2% is actually a 6% increase in your budget. So it would have helped you a little bit, but it can save a bad retirement date, and you can suddenly take it from a 3.3 to a 4.0% safe withdrawal rate.
So right now, and again, I think people have been saying the sky is falling in our economy for, I don't know, years now. I'm probably one of those who think that, but for some reason we are now at all-time highs or flirting with all-time highs once again. However, there are some economic indicators that hint at some rocky road coming forward. And that's not unreasonable to believe that. Whether you know for sure that's going to happen, we just don't know. But if you're planning for your own retirement, you want to mitigate against that. So let's, for academic sake or entertainment sake, probably more likely, not actual advice. If someone retires right now, and let's say it's at the beginning of a bear market, what are some things that retiree should consider? You've already mentioned that one good starting point is to go 70-30 and then adjust from there as you move forward through your retirement. But are there other particular assets that perform better in a down market that can help? And do you advocate for that? Or do you just want to keep it simple and just go general index 70%,
right,
30% bond fund?
So the quote unquote solution that a lot of people propose is, one would be flexible, right? So if you have the flexibility to lower your withdrawals, you could probably start with a little bit more initially, and then you take it down if the market doesn't cooperate. The problem with that is, and I've built some tools to study that on my side, people underestimate that the length of time that you need to be flexible, right? So sometimes people have this wrong impression that you have to be flexible only for as long as the bear market lasts. The problem is, once the bear market is over, you're still at very depressed equity valuations, right? So sequence of return risk means you're taking money out at depressed valuations. And the day after the bear market is over, you're still very depressed. In fact, you're more depressed than at the beginning of the bear market. So the fact that the bear market is over is not particularly meaningful. What is meaningful is how many percent are you below what you started with at your retirement. And portfolio might suffer much longer than what you believe, right? Because not only has the market has to recover, but it has to recover, also compensate for inflation, and also has to compensate for your withdrawals, right? So even though your portfolio might have recovered, the stock market might have recovered, but your portfolio might still be down because you took money out, and so flexibility is a solution, but it comes with a bit of a cap, right? The other strategy, obviously, is you have to find more returns, right? And that's obviously the holy grail. And I don't think that some people propose something like small cap value stocks, and I know you had Merriman on the show. So I personally don't believe that. There's actually a pretty good discussion between the two at one of the Bogleheads conferences where Rick Ferry does a very good job of taking down that small cap value argument. And I have a blog post too, why I don't believe that small cap value is really a viable solution, even though historically you could point to some outperformance. Small cap stocks had a very good run from the 1920s to about 1982, 84. And after that, there's really no more excess return from small cap stocks. And value stocks did well for a little bit longer, but then also the last 15 to 20 years, they've also sputtered and actually underperformed growth stocks. No surprise, right? NVIDIA and all the tech stocks are doing really well, and value stocks actually lag behind, especially small cap value stocks. So short of a glide path, which is what you can do with just plain index funds,
Can you describe glide path real quick?
So again, that reverse glide path would be and if you think that you want to have something like a 75-25 portfolio, maybe overcompensate at retirement date and go to 60-40 in light of, recession and bear market might be around the corner. And then during retirement, you take that up again, and maybe every month you go up 0.2%, 0.3%, 0.4%, and shift back into that portfolio. You might even go all the way up to 100-0. That might be mathematically, historically was very good. Now I don't know if most people have an appetite for that. So that's obviously something to do. So short of coming up with some kind of an alpha strategy, and I'm doing some option trading, which is also something that I think not everybody should do, because that takes some specialized skills and background. I think for the average retail investor, just be a little bit cautious. And I think lots of people can afford that, right? Because they benefited on the way up from the big run up in equities. If you now take some chips off the table and you do 60-40, then I think you should be pretty well positioned, even if the market takes a downturn. Because definitely, if you look at equity valuations, it's very richly valued. So the CAPE ratio is well above 30. I think it's something like 33, 34. I have an adjusted CAPE ratio that I publish on my blog. It's actually part of that safe withdrawal rate spreadsheet too. I update that every day or almost every day if I get to my computer every day. I think that's at 29 now, so that's still extremely high. So the adjustments take out some of the historical inequities in the construction of the CAPE because people have pointed out, you can't really compare today's CAPE of 34 with the historical CAPE of 34 because certain things have changed, and I'm not going to get too much into the technical stuff there. It has to do with different corporate taxation and different dividend payout ratios, because today's dividend payout ratios are a little bit lower and there's more retained earnings that can grow internally. There's some people who say that we can generate a little bit higher CAPE ratios without being too afraid, because the way the CAPE is constructed, we have to make some adjustments to that, because corporate profits have now more growth potential because corporations keep more money internally on their balance sheet and reinvest it internally. But even with these adjustments, we're still extremely high at almost 30. And it's very expensive. And every single last historical worst case scenario started in exactly the situation that we have right now, right? Like 1929, and it's very high CAPE ratio. Also decent interest rates on bonds. So I think take your withdrawal rate down a little bit. Target it, tailor it to the historical worst case scenarios, and then maybe do something like, maybe don't do 80-20, do something like 70-30 or even 60-40, because you can probably afford it, right? Because your stock portfolio performed so well over the last few years that you just take some chips off the table there.
I'm going to put you on the spot here. Do you think we're going to have a recession in the next 12 months?
I look at a few economic indicators, and obviously yield curve inversion historically has been a very good indicator for a recession and a bear market. And while that yield curve inversion has been going on for so long now, so it's actually, I think a lot of economists are praying for a recession, because that was one of their best indicators. It's not the only indicator you would use, but so that is screaming red and recession. There are a few other indicators. If you look at something like industrial production or the PMI index, as a purchasing managers index, they're all kind of sort of hanging on. Usually what you would see at the onset of a recession is an increase in unemployment claims. That hasn't materialized yet. So I would say that out of the indicators that I usually look at, I wouldn't say that there is an urgent call for a recession anytime soon. The yield inversion, maybe this is the first time that we have no recession after a yield curve inversion, because the Fed has a lot of credibility and did a lot of very fine tuning and to basically thread the needle, raise interest rates without causing a recession, which normally in the past they raised interest rates and then they overdid it and then caused a recession. Maybe this time they did it just right, and because it's true that they stopped raising interest rates when inflation was still quite high. And it was high, but coming down. So maybe the Fed did something little bit more nimble and intelligent than what they did in the past. Also, what helped was because of the pandemic and all of these cash help that was on the consumer balance sheet. When the recession would have normally happened, right, in 2022, 2023, when the Fed raised interest rates, the consumer was still extremely healthy. So usually late cycle, the consumer is already a little bit over leveraged, and you raise interest rates, you would normally cause a recession. So my personal theory why the yield curve inversion hasn't caused a recession, well, for the yield curve inversion doesn't cause a recession, but why the yield curve inversion hasn't coincided yet with a subsequent recession is that, it's going to slow the economy, but the economy could afford some slowing because the consumer was still quite solid from all of these handouts that we got in 2020, 2021. And then some other macroeconomic signals, they don't really scream recession either. The only thing that screams recession is the yield curve. But then again, other indicators in finance, something like yield spreads, right? So the corporate yield spread, that hasn't shot up yet. That's normally what happens right around the recession start. I mean, that's obviously something that I would monitor. If anything changes, I'll probably publish that on my blog. But again, I don't quite see the urgent need to call a recession over the next 12 months. It's elevated. It's not really screaming recession yet.
So if I'm about to retire, or I think my numbers look pretty darn good, I'm ready, are you saying I should not be worried right now as long as I take some kind of steps, maybe a 70-30 portfolio, to go ahead and retire now, even though there are some indicators out there that indicate that the future economy might be suspect?
Right. So, and again, if you put me in the time machine and you tell me, well, what is the probability that I land in a recession month? I think it's about 13 to 15%, right? Completely unconditionally, right? Or historically, I think 13% of the months we were in a recession, 87% of the time we were not in a recession, we were in an expansion, right? And then the stock market obviously goes hand in hand. I think every recession in the past has been accompanied by a bear market. And then there were some bear markets that didn't have a recession, right? 1987 technically was a bear market. 2022 was also a bear market, quite an extended one and deep one. We never had a recession. So, so obviously, completely unconditional, you have already a 13% chance of a recession. So, and then I just told you, there is some, it's not screaming 100% recession or 80% recession risk over the next year, but maybe it's a 25 to 30% chance of recession over the next 12 months, because it is elevated because of all sorts of factors, geopolitical, right? Uncertainty after the election. I don't want to get into that any more than that. I'll just say that. There's uncertainty about Federal Reserve policy. Might they increase rates some more if inflation doesn't come down on its own? Housing market is a little bit overextended. Could that crash? People maybe some kind of civil unrest because people had it with high rents and high food prices. So there's some uncertainties. I'm not saying that it's zero. I'm not saying that it's 100%, but I'm saying that completely unconditionally, it's already 13 to 15%, and it is a little bit elevated. So it's more than that. So if you retire today, you potentially retire at the peak of a bull market, and we have another bear market. I can't tell you how deep the bear market is going to be if we have a recession. In some way, 2022 was the bear market that was associated with that yield curve inversion, but there was no economic recession. Maybe this is over, and we don't have to worry about the economic recession anymore. But if there's an economic recession, there will be a bear market. It's a 20 or 30% chance that we have one. Question is, do you want to retire and maybe have a 20 to 30% chance of running out of money, right? And I always tell this analogy. If you go to the airport to catch a flight, I'm not talking about a connecting flight, but you go from your home to the airport, would you be willing to miss your plane with a 20 to 30% chance? Have you, in the 100 or so times that you took a round trip and fly somewhere on vacation, have you missed 20 to 30% of your flights because you arrived at the airport late? No, you go to the airport, and I have never missed a flight. One or two times it was a little bit tight, but I've never missed a flight out of maybe maybe 500 flights or so I've taken in my life, where I was in charge of making it to the airport. I'm not talking about connecting flight. I'm talking about going from my home to the airport, or going from my hotel or friend's house or family's house back to the airport and flying back. So out of 500 times, I have missed exactly 0 flights. And because I'm not willing to have a failure rate of 20%, I'm not even having a 1% failure rate. And so the question is, are you willing to have a 20 to 30% failure rate with your retirement strategy, which is a little bit more substantial, a little bit more money on the line than missing a flight? Well, maybe they rebook you and it costs a few $100s. But we're talking about hundreds of thousands of dollars, maybe millions of dollars if you run out of money after 20 years. What would kind of the damage that I would assign of a failure in my retirement strategy. So I'm not willing to have a 20% failure in my retirement strategy. And if you miss 20% of your flights and you're totally fine of saying, I don't want to waste any time at the airport, I'm just going to go willy-nilly to the airport. Maybe it works for other people, but for me personally, I don't think I want to have a 20% chance of failure. So you might face a chance of a bear market coming up. So yes, you absolutely want to tailor your withdrawal strategy to something that looks like maybe the Great Depression or the 1960s. And if it works out better than that, you can always raise your withdrawals. The most people I know, it's actually the other way around. They have so much money saved, and they have a 2.5% withdrawal rate, and they ask me, "Oh, am I safe? Am I safe?" I say, "Of course you're safe." It's actually most of the time is actually the other way around, where people are afraid of a recession. And they think they have to take down their safe withdrawal rate from 2.5% to 1.5% because there's a recession around. Now that's kind of crazy. But I don't recommend that somebody say who has $600,000 saved and they say, oh yeah, I can do a 5% withdrawal rate and I can live off of $30,000 a year and I'm just going to make it work. I'm just going to be flexible. Probably that sounds a little bit too scary. That might have something like a 20 or 30% failure rate. And I would not be comfortable with that. But most people, you made a lot of money on the way up, and maybe take down your retirement budget a little bit. You can still retire today with a very, very generous safe withdrawal rate, and it might be a little bit below 4%. That's fine too, but it's still going to be awesome in early retirement. So.
All right, Karsten, thank you so much. I would say this, if the first time I think I ever met you, honestly, I don't even remember the very first time I ever met you, but I remember the feeling of like, I think I know this stuff pretty well. And then I either eavesdrop into a conversation that you're having with somebody else, or you give a presentation, and I'm thinking, this dude is on a whole other level, and I'm so glad to know him.
Okay, that's good. That's a good compliment. Yeah, thank you.
Yeah, and please take it as one.
Yeah.
And people ask me about secrets of returns risk, and of course, I'm familiar with Trinity study and 4% rule and safe withdrawal rate. However, I don't really get into it that deep with them, other than just the very surface level. And I say, if you want to know anything more about safe withdrawal rate, and you want to know more because this is your life here,
right,
go to Big ERN's website, earlyretirementnow.com. He's got 61 posts on this stuff. And I can't imagine the dinner discussions that you have with your wife on this. I'm sure she's just got to be completely enthralled. But I know she's benefiting from all of your knowledge and your willingness to put it in place.
Yeah, funny thing is, with my wife, I talk about my day. How was the market today? How did your trading go today? We don't really talk about safe withdrawal rates and sequence of return risk. And the nice thing is that, well, we feel safe enough that we don't have to worry about it, right? So, I mean, don't worry about money, right? Or don't think about money. Don't worry about running out of money. That's a great comfort. That is a great luxury that we can talk about a lot of other things. And the kind of financial stuff is usually not that big a topic. But my wife has a technical background too. She has an engineering undergrad degree, so she appreciates anything that has to do with engineering and math. So and she's a nurse too, so she has both. She has two careers, one in nursing and one in engineering. So but she appreciates what I do. She doesn't ask me every day, hey, how is what's your recession risk and what's your sequence of return risk indicator for today? So she trusts me on that. So it's a great luxury to have.
Yeah. Well, thank you. I'm very, very glad to know you, and I really do appreciate you taking the time on very quick turnaround time. I think I just texted you a couple of days ago, say, hey, do you want to come on? You're like, yeah, let's do it.
Yeah.
So I'm very grateful, and I'm sure our audience will be grateful as well. Thank you very much for chatting with me, Karsten, and thank you all for watching and listening.
Thank you.